America just crossed $38 trillion in national debt, and the world's confidence in the dollar is collapsing faster than at any point in the last 30 years. Interest payments have exploded past $1.2 trillion. Foreign governments are dumping U.S. Treasuries, and for the first time in modern history, gold and Bitcoin are surging together, a universal warning signal that a currency system is breaking. Behind closed doors, the U.S. is preparing a reset so radical it rewrites how the dollar works, who controls it, and how America survives its own debt spiral. What comes next isn't a forecast, it's already underway. The U.S. economy has reached a stage where debt no longer functions as a tool. It has become a structural threat that magnifies itself with every passing quarter. What makes the current crisis uniquely dangerous isn't the size of the national debt alone, now surpassing $38 trillion, but the velocity at which the system is losing its protective layers. For decades, global confidence acted as the stabilizer. The world trusted U.S. debt so deeply that it accepted low yields, low-risk premiums, and infinite refinancing. That confidence is no longer guaranteed, and once it falters, every dollar of debt becomes exponentially more expensive to sustain. The numbers reveal how quickly stability can invert. In just 5 years, interest payments ballooned from $500 billion to over $1.2 trillion, consuming more than 20% of federal revenue. This is not just fiscal pressure, it's a macroeconomic fracture. When interest obligations rise faster than tax receipts, the government becomes trapped between raising rates to defend the dollar or suppressing rates and letting inflation erode purchasing power. Either choice accelerates the doom loop because both routes undermine confidence in long-term treasuries. The heart of the spiral is what economists call the term premium, the extra yield investors demand to hold long-term U.S. debt. Historically, it sits near 2%, but today it hovers around 0%, artificially low and dangerously fragile. If global investors decide the U.S. fiscal position is deteriorating, which the debt trajectory clearly signals, the premium can snap back instantly. A shift from 0% to 2% would push the 10-year Treasury from 4% to roughly 6%, triggering a chain reaction across mortgages, corporate loans, and state financing. Suddenly, the entire credit structure becomes more expensive overnight. This is where confidence transforms from an asset into a liability. The U.S. relies on investor trust more heavily than any nation in history. Once that trust weakens, debt refinancing becomes a destabilizing force rather than a safety mechanism. The doom loop begins when rising rates undermine confidence, and falling confidence pushes rates even higher. It is self-reinforcing, self-accelerating, and impossible to unwind without introducing a new mechanism to absorb demand for U.S. Treasuries. And that is precisely why the government is quietly engineering a monetary reset through digital infrastructure, the only way to create a new class of debt buyers before the old ones disappear. The unraveling of U.S. reserve dominance is not theoretical. It is quantifiable, accelerating, and now visible in data that central banks once hoped would never surface. For more than 2 decades, the U.S. dollar held a firm grip on global reserves, consistently controlling 60 to 72% of worldwide foreign exchange holdings. That stability created an illusion of permanence, a belief that no matter how aggressively America borrowed, the world would always demand dollars. But in the last 24 months, that assumption has shattered. The dollar's share has slipped below 60%, marking the sharpest erosion in over 30 years, and the trend line is now falling at its fastest pace since the aftermath of the Vietnam War. What makes this decline so dangerous is its timing. The dollar is losing global dominance precisely as U.S. debt is exploding past $38 trillion, and as interest costs are rising at a scale not seen in modern finance. Reserve status is what once kept the U.S. insulated from the consequences of its own spending. It ensured foreign governments would automatically buy treasuries, restraining yields and reinforcing the credibility of U.S. debt. But today, the world's largest reserve holders, China, Japan, Saudi Arabia, and key emerging market blocs, are reducing exposure. China alone has slashed its treasury holdings by over $300 billion in recent years, and Japan's portfolio has contracted as its domestic monetary pressures intensify. Behind every percentage drop in dollar share is a fundamental truth. Global confidence is no longer unconditional. Nations that once recycled trade surpluses into U.S. bonds are now redirecting capital into gold, commodities, bilateral currencies, and regional payment systems. This shift doesn't merely reduce demand for the dollar. It weakens the structural anchor that suppressed long-term interest rates for decades. When fewer governments hold dollars as reserves, fewer governments step in to buy treasuries when markets tighten, leaving the U.S. more exposed to yield spikes triggered by the debt doom loop. The weakening of reserve dominance directly amplifies the fragility already destabilizing U.S. borrowing costs. As the world diversifies away from the dollar, the margin of safety surrounding Treasury demand shrinks, pushing the system closer to a scenario where the U.S. must create new external demand mechanisms to stabilize its currency. That pressure sets the stage for the government's next move, engineering alternative buyers through digital markets to prevent a full-scale confidence break. The most dangerous element in America's financial structure isn't the debt itself. It is the silent multiplier attached to that debt, the term premium. This single metric determines how much extra yield investors demand to hold long-term U.S. treasuries, and for decades it acted as a quiet buffer shielding the government from the full cost of its borrowing. But that buffer is evaporating, and once it fully resets, the consequences will be immediate, violent, and irreversible. Historically, the term premium averaged 2%, reflecting strong global confidence in America's long-term stability. That confidence allowed Washington to borrow trillions at artificially low rates because investors were willing to accept reduced compensation for holding U.S. debt. But today, the premium sits near 0%, an abnormal reading that exists only because markets still hope the U.S. will maintain credibility. The problem is that hope is thinning, and when it breaks, the term premium will not return gradually. It will snap back like a coiled spring. A move from 0% to 2% may sound small on paper, but it would push the 10-year Treasury yield from roughly 4% to 6%, instantly raising the government's refinancing costs by hundreds of billions of dollars. Mortgage rates would surge, corporate financing would tighten, and credit markets would feel the shock within days. The U.S. is already paying more than $1.2 trillion annually in interest. A premium normalization would drive that figure even higher, forcing deeper deficits and accelerating the very loss of confidence that triggered the spike. What makes the term premium so dangerous is its sensitivity to global perception. It reflects not inflation, not Federal Reserve policy, but trust, specifically, trust in America's long-term fiscal direction. As foreign central banks reduce their Treasury exposure and the dollar's reserve share declines, the market's willingness to accept a near-zero premium becomes increasingly unsustainable. Once investors decide the risk embedded in U.S. debt is underpriced, yields will adjust instantly, with no political negotiation and no central bank intervention capable of reversing the psychological shift. This is the hidden vulnerability linking America's debt spiral to the erosion of its global reserve status. When the term premium resets, the system will face borrowing costs it was never designed to withstand, forcing the government to search for entirely new sources of demand for its debt. The most alarming confirmation that global trust in U.S. debt is weakening comes from the two nations that once kept the Treasury market stable almost single-handedly, China and Japan. Together, they held more than $2 trillion in U.S. Treasuries, acting as the backbone of foreign demand for American debt for nearly 2 decades. Their shift from aggressive buyers to consistent sellers marks a structural break in global finance, one with direct consequences for the U.S. interest rate system already strained by the declining reserve share and the unstable term premium. Japan, long the world's largest foreign holder of treasuries, is reducing exposure at a pace unseen since the early 2000s. The reason is simple but devastating for U.S. borrowing costs. Japan is fighting its own currency crisis. To defend the yen, the Bank of Japan has allowed domestic yields to rise from near zero to levels that finally attract Japanese investors back home. Every uptick in Japanese government bond yields drains capital out of treasuries. In effect, America is losing a decades-long subsidy that artificially suppressed its long-term interest rates. China's motivations are even more consequential. Its treasury holdings have fallen by more than $300 billion from their peak, and the decline is accelerating. But China isn't merely reallocating capital, it's restructuring its entire geopolitical financial strategy. The weaponization of the dollar through sanctions, the shift toward yuan-based trade settlements, and the push for commodity-backed reserves all make U.S. debt less attractive for Beijing. For a nation that imports massive quantities of energy and raw materials, holding treasuries has become strategically risky and economically unnecessary. This dual exit creates a vacuum the U.S. cannot easily fill. China and Japan were not ordinary investors. They were predictable, long-term stabilizers who absorbed treasury supply during periods of stress. Their withdrawal reduces the liquidity cushion that once kept yields anchored, making the system far more vulnerable to sudden rate spikes triggered by confidence shocks or fiscal deterioration. With the two largest foreign backstops stepping away, the U.S. faces a new reality. Traditional government buyers will no longer absorb its expanding debt. And without them, Washington must find an entirely different class of buyers, one capable of replacing sovereign demand on a global scale. That search leads directly into the emerging world of digital dollars and crypto-backed treasury consumption. As traditional foreign buyers retreat from U.S. debt, the government is quietly cultivating a new class of demand, one that does not rely on geopolitical alliances, trade surpluses, or diplomatic goodwill. Instead, it relies on the explosive rise of stablecoins, digital tokens backed by real U.S. dollars, and, more importantly, U.S. treasuries. What began as a niche tool for crypto traders has evolved into one of the most powerful external engines of treasury demand in the world, growing at a speed foreign central banks cannot match. The numbers reveal the scale of the shift. The combined market capitalization of major stablecoins has surged to roughly $200 billion, doubling within just 2 years. And unlike traditional currency reserves, which fluctuate based on political considerations, stablecoin issuance is tied directly to market demand. Every new token must be backed by safe liquid assets, primarily short-term U.S. treasuries with yields between 4 and 5%, making them ideal collateral. As a result, issuers like Tether and Circle have accumulated treasury holdings comparable to mid-sized sovereign nations. They are no longer fringe players. They are among the fastest-growing holders of U.S. government debt on the planet. What makes this development strategically valuable for Washington is that it creates synthetic global demand for treasuries at a time when official foreign buyers are stepping away. The U.S. doesn't need China or Japan to purchase long-term bonds if millions of users across emerging markets absorb digital dollars for daily transactions. From Latin America to sub-Saharan Africa, stablecoin adoption is rising at annual rates above 30%, driven by unstable local currencies and unreliable banking systems. Each user indirectly increases demand for U.S. debt without ever interacting with the treasury market directly. Stablecoins function as a backdoor mechanism. They embed treasury purchases inside the plumbing of the global digital economy. Unlike central banks, which can reduce holdings due to political tensions, stablecoin demand grows organically through market forces. This is why Treasury officials project the sector reaching $2 trillion, a scale large enough to rival, and potentially replace, the lost demand from Asia's declining buyers. This emerging digital infrastructure provides exactly what the U.S. needs: a new engine capable of absorbing debt in a world where traditional reserve structures are eroding. And it sets the stage for a deeper transformation, one where the government no longer relies on nations but on networks to sustain its financial dominance. What appears on the surface as regulatory interest in crypto is, in reality, a coordinated strategy to rebuild global demand for U.S. debt through a digital architecture. The U.S. government understands that its financial dominance cannot survive on legacy reserve systems alone, not when major foreign holders are reducing exposure and confidence-sensitive metrics like the term premium are poised to surge. The only viable path forward is to migrate the dollar into a framework where demand grows automatically, independent of geopolitical pressures. That framework is the emerging digital dollar ecosystem, built around stablecoins, regulated token issuance, and Treasury-backed digital assets. This is not a formal reset declared on national television. It is a structural reset embedded into market behavior. By allowing and regulating stablecoin issuers to operate at scale, Washington gains access to a buyer base far broader and more resilient than traditional sovereign holders. A digital dollar circulating across millions of wallets forces continuous treasury purchases in the background, converting global currency demand into a perpetual refinancing mechanism. Treasury Secretary projections of a $2 trillion stablecoin sector are not speculative. They reflect the scale needed to offset declining foreign participation. The strategy becomes even clearer when examining legislative trends. New frameworks for crypto custody, dollar-backed tokenization, and payment stablecoin regulation all converge toward a single outcome: a digital dollar system built primarily on private market rails but anchored to U.S. sovereign debt. The government no longer needs to print new dollars directly. It can outsource the process to stablecoin issuers whose growth organically increases treasury demand. This converts the dollar from a government-issued asset into a hybrid digital instrument that expands in response to global market need. The brilliance of this approach lies in its deniability. There is no headline announcing a reset, no sweeping monetary reform. Instead, the dollar evolves quietly into a dual-structure currency. One legacy layer tied to traditional reserves, and a second layer, faster, borderless, algorithmically collateralized, designed to absorb trillions in sovereign debt without formal intervention. This is the hidden path the U.S. has chosen: a reset that avoids triggering panic, leverages market incentives, and builds a new foundation of demand just as the old one begins to collapse. The digital dollar strategy offers the U.S. a new source of demand, but even its most optimistic projections collide with a mathematical wall. A stablecoin market worth $2 trillion may be unprecedented in global finance, yet it represents only a fraction of the burden required to support a treasury market that has ballooned beyond $38 trillion. This mismatch is not symbolic, it is structural. Digital demand can offset the decline of individual foreign buyers, but it cannot counteract the scale and acceleration of America's debt trajectory. The first constraint is sheer magnitude. Even if stablecoin issuers allocate the majority of their reserves to short-term treasuries, their combined holdings would cover only around 5% of the total debt load. Meanwhile, the U.S. is adding $1 to $1.5 trillion in new deficits every year, a pace that outstrips the growth rate of the entire digital asset sector. No matter how fast adoption rises in emerging markets or how deeply stablecoins penetrate global transactions, their expansion cannot match the velocity of the federal government's borrowing requirements. The second constraint is duration. Stablecoin issuers overwhelmingly favor treasury bills and short-term notes because liquidity is essential to maintaining price stability. But the U.S. requires buyers across the entire maturity spectrum: 2-year, 5-year, 10-year, and 30-year bonds. The digital ecosystem cannot fill that role without destabilizing its own infrastructure. A market built on instant redemptions cannot support long-duration debt that fluctuates violently with interest rates. Finally, the digital sector is inherently cyclical. Regulatory shifts, market volatility, and technological vulnerabilities can shrink stablecoin supply just as quickly as they expand it. Treasury markets, by contrast, demand consistency. They cannot rely on a buyer base whose balance sheets rise and fall with crypto liquidity cycles. This is the unavoidable limit of the digital dollar reset. It can slow the crisis, redistribute demand, and offset foreign withdrawal, but it cannot reverse a fiscal trajectory that climbs into the tens of trillions. The gap between a $2 trillion digital mechanism and a $38 trillion federal liability forces the U.S. toward a deeper conclusion. Additional tools will be required, and investors are already positioning themselves for what comes next: an environment where trust migrates from government debt to hard, non-sovereign stores of value. As traditional sovereign buyers retreat and the digital dollar mechanism hits its structural limit, global capital begins to behave in a way that exposes the true level of anxiety inside the financial system. Investors are no longer seeking yield, they're seeking escape. This shift is clearest in the simultaneous surge of gold, Bitcoin, and other hard assets, a rare convergence that historically appears only when confidence in government debt weakens across multiple regions at the same time. Gold's movement alone reveals the severity of the moment. Despite elevated interest rates, conditions that normally suppress precious metals, gold has shattered record highs, climbing past $2,400 and holding its momentum. This is not a speculative rally. It is a capital migration. Central banks purchased more gold in the last 2 years than in any period since the 1950s, diversifying away from dollar exposure as reserve shares fall. Their actions expose a reality they cannot state publicly. Long-term trust in U.S. debt is eroding, and gold remains the only politically neutral hedge against sovereign instability. Bitcoin's ascent is even more revealing. It is becoming a macro asset, no longer tied to niche speculative cycles. Its rise during a period of tightening liquidity contradicts past patterns, signaling a shift in perception. Investors now see it as a hedge against systemic debasement, especially as annual U.S. deficits exceed $1 trillion and global reliance on the dollar becomes more uncertain. The fact that Bitcoin rallies alongside gold, a convergence historically unseen, indicates a broad reallocation away from government liabilities and toward assets outside sovereign control. This migration extends beyond metals and crypto. Investors are moving into energy assets, farmland, and resource-backed equities, all of which preserve value during episodes of currency dilution. These flows are not temporary. They reflect a strategic repositioning for a world where digital demand alone cannot stabilize a $38 trillion debt load. The rise of hard assets marks the transition point in the broader financial reset. Once wealth begins exiting the debt system, it becomes increasingly difficult to reverse. And the next stage unfolds when the dollar itself begins splitting into two parallel ecosystems, one legacy, one digital, setting up the most significant monetary divergence of the modern era. The fractures forming in the global financial system are no longer abstract. They are materializing directly inside the structure of the US dollar itself. For the first time since the end of Bretton Woods, the dollar is dividing into two parallel systems, each with its own rules, risks, and sources of demand. This emerging split is not a policy choice but a structural response to a world where America's traditional debt backstops are evaporating. As foreign governments reduce Treasury holdings, and as the reserve share of the dollar erodes, Washington is forced to evolve the currency into a model capable of sustaining demand without relying on sovereign buyers. This is how the dual dollar ecosystem begins. The legacy dollar system, the one the world has used for decades, relies on central bank reserves, long-term treasury markets, and global trust in U.S. fiscal governance. Its strength comes from the belief that the United States will honor its obligations indefinitely and that treasuries remain the safest collateral in global finance. But this system is increasingly constrained by structural deficits, rising interest burdens, and the risk that the term premium may normalize at levels that make borrowing unsustainable. It is a system showing visible strain, dependent on confidence that is no longer unquestioned. The second system, the digital dollar ecosystem, grows from entirely different mechanics. Here, demand doesn't come from foreign ministries or global institutions. It comes from millions of individuals and businesses across emerging markets using stablecoins for transactions, savings, and cross-border transfers. Every dollar token in circulation forces the purchase of short-term U.S. treasuries, effectively embedding sovereign debt into the infrastructure of the digital economy. This network expands without political negotiations, without trade agreements, and without reserve treaties. It scales according to market behavior, not government diplomacy. Together, these two systems create a monetary bifurcation with enormous consequences. The legacy dollar depends on stability, credibility, and fiscal restraint, conditions the U.S. is struggling to maintain. The digital dollar depends on adoption, speed, and technological reliability, conditions that can grow exponentially but lack the capacity to support the full weight of a $38 trillion debt load. As the split widens, global capital will increasingly decide which version of the dollar it trusts more. The result will be a fractured monetary landscape where the U.S. maintains influence through digital rails even as traditional financial anchors weaken. But the real crisis emerges when these systems collide with the final constraint: market rejection of US debt before the digital dollar infrastructure is large enough to absorb the shock. If global investors demand higher yields at the same time reserves continue to diversify away from the dollar, Treasury markets will face a liquidity shortfall that neither the Federal Reserve nor the stablecoin sector can fully cover. A jump in long-term yields from 4% to 6% or higher would push interest payments far beyond the current $1.2 trillion, triggering a fiscal spiral impossible to unwind through conventional means. This is the heart of the final equation. If the world rejects US debt before the reset is mature, America will enter a phase where debt can no longer be rolled over at sustainable rates. The government will be forced to choose between three destabilizing outcomes: aggressive monetary intervention risking inflation, drastic austerity risking economic contraction, or a quiet, deliberate devaluation of the dollar masked as digital modernization. None of these outcomes preserve the old system. All of them accelerate the transition toward a redesigned monetary order. The digital dollar strategy buys time, but it cannot rewrite arithmetic. A system built on perpetual borrowing cannot function when confidence erodes faster than new mechanisms can expand. The global shift into gold, Bitcoin, and hard assets signals that investors already understand the stakes. They are preparing for a world where the US dollar survives, but not in the form the world has known for the last century. And when the break finally comes, it won't feel like a collapse. It will feel like a replacement, the moment the old financial era ends and a new one rises from its shadow.